So guys, have you ever wondered which of these five UK insurers would be the best investment for your portfolio today? There are mixed views amongst the analyst community, but at least two of the companies have really large dividends that could propel your portfolio forwards. So let's find out together which of these companies could be the best portfolio booster, best stocks to invest into. And if you stick around until the end, I will share my holdings in these companies and the performance to date. So without further ado, on with the video. I'm going to start with the Solvency II ratio, which is a ratio designed to show the chance to meet obligations. It absolutely must be over 100. The higher the better, and I'm looking for a minimum, let's say 150, and ideally closer to 200, which is represented by the white dots. If we look at the individual company values, the Aviva is very close to that 200. Great news, there's a tick in the box for them. Legal and General exceeds. Direct Line is just a touch below, and Admiral's in the middle. So they're all doing quite well, but Aviva and Legal and General come out on top. Notice there's no value for Prudential because Prudential, although registered on the UK stock market, does not have proper operations in the UK. It's more in the Asian sector. A lovely graph for you here, which is comparing the debt to equity ratio and the interest cover, and then bringing in that Solvency II ratio information we discussed. So along the bottom here, we've got debt to equity, so we want to be lower in this left-hand side for the bottom axis, and then for the top axis, we want to be higher because it's interest cover. We want that to be as high as possible. So grid lines, so this quadrant here, we can see the mouse moving. At the further to the top left, you are on that quadrant, that's the high quality area. So we've got over here, Legal and General, really high debt to equity. But the interest cover is quite good, and the solvency ratio is also very good. So maybe that debt to equity isn't so much to worry about. And you can see how by visualizing this information together, we get a fuller picture rather than just looking at metrics individually. And we've got Aviva down here. Now, Aviva's interest cover is very low, but their debt to equity is also very low, and their solvency ratio again is quite good. So again, it's actually probably not as bad as it sounds just looking at their interest cover, which is actually negative. The reason is their 2022 results. They had some unusual results due to revaluations of investments. It's actually representative of their strength and their long-term progress. These two kind of grey coloured dots show the target and the ideal, and actually the only company that is close to those really is Admiral. So again, we get slightly different results looking at these three together rather than just looking at the Solvency II ratio by itself. This is Prudential, the small dot, because they don't have a Solvency II ratio, but you can see it doesn't do too badly, but we'd like the interest cover to be a bit higher. What we can take away here, none of these companies are going to fail in the very short term. Here we go, this is the one you've been waiting for. We move on to the dividend. And I've got three bits of information conversion to one to help us make an assessment. For the insurance companies, they're very unlikely to be fast growing companies, they're more stable. So the dividend yield is very important, part of the return. That's one aspect. And then can they afford that dividend? That's the payout ratio. We want a higher yield to an extent, but then the payout ratio to be lower. We also then want to look at the book value because insurance companies are very much assets and liabilities. And therefore, if they are trading below book value, that means there could be some capital return as well. Number that you'll see, size of the dot, the larger the dot, and particularly if it's above 1, the more undervalued it is. I'm using the inverse of the book value, so the bigger the dot, the more undervalued it is. So the target range is here. You want a valuation of this size of dot with a payout ratio of 60% and a minimum dividend yield of 4%. Ideally, you'd actually have a bigger amount of undervaluedness, a dividend yield of 6% and a payout ratio of 30%. So this is the area we want our companies to be in. Immediately, my eye is drawn to Legal and General. It's probably not undervalued. It's trading at an inverse book value of 0.91, so that's a book value of probably 1.1. So not necessarily overvalued either. trading reasonably near fair value, and they're in this sort of dividend strike zone. You can see that looks like a yield of getting on for 8% and quite a low payout ratio. So Legal & General looks like it's winning. I think they had the best solvency ratio before as well, and pretty good interest cover. All the way out here, you've got Admiral. Based on their last results, it suggests they can't afford their dividend because that payout ratio is over 100%. Down here, you've got Aviva that have a negative payout ratio because of the oddity in their results around losing money, but it isn't actual losses. And Direct Line stopped their dividend, so they've got zeros. So really, to me, Legal & General from this visualization is emerging as a front runner. Prudential looks pretty good, but that is quite a low dividend yield, and they're trading not at a particular discount to book value. The story so far is that I think Legal & General is the strongest candidate. If you check in the video later, you'll see that I do hold a position in Legal & General. I'll share with you how that's been going. Now we're into the long-term trends. Let's get a better idea of what's really going on rather than oddities in one-year results. Start with the dividend yield. There's a white line going across at 4%, which is the minimum we really want, and our deal line going across at 6%, 2013 to 2022. And if we take each company in turn, you can see that Prudential's dividend yield has always been quite low. Direct Line, we can just bring that one up. That's always actually had a very good dividend until they just cut it recently. You'll see that a lot of them dipped during 2020 because of the virus situation, understandable, because of unknown risks. Now, Admiral, if we can just bring up Admiral, there we go. That Admiral there is pretty nice. It's a very consistent, slow increase over time in the yield percentage. Now, there's always going to be an element of inconsistency because yield is a function of price. Bear that in mind. Aviva, general trend very much is upwards, subject to the 2020 adjustment. And Legal & General, that looks really good. So far the story, Legal & General is looking at the best. That's dividend yield. Is that surprising to you? I'd love to hear from you in the comments below how you feel about those trends. I'm bringing it back. We're looking at the payout ratio for all these companies. Awesome. And then we've got 30%, which is the ideal ratio if you're being really, really stringent and strict. But 60% is fine as well. You want them to be around about those two white lines. You can see that Aviva's, if we just hover over them, that has actually taken a bit of a nosedive because of the odd results in 2022. You can see from 2016 to 2021, there was a good trend in moving into that nice low payout ratio zone. So they were doing pretty well. Admiral's kind of started going the other way, dividend becoming less affordable. Direct Line has generally been around about 60%, a little bit plus or minus, until again they've stopped the dividend last year. Legal & General, now look at the consistency here from Legal & General. Beautifully flat line there. So again, they're really smashing this. Prudential, it was consistent. It's had some very odd jumps around in the last few years, but there's only really 1 year where it's outside the good zone. They've come out quite well here as well. I'm bringing in a new metric here, return on equity. So how effective are they at making returns? And Aviva's, first of all, is quite poor. Really quite poor, actually. It's been on a downward trend. I wonder whether the divestments have impacted that, whether they'll stabilise in the future. Certainly that's positive there. Direct Line as well was very, very consistent until last year. Prudential, that's generally been edging downwards over the period. Legal & General, that's been pretty good, pretty stable. Really good return on equities. And Admiral's actually really, really high figure, much higher than all the others. That has been consistently coming down for the last 5 years or so. And for those of you newer to the term, here is the definition of return on equity. The key word being gauge of profitability and how efficiently it generates those profits. We're just going to move on to the debt to equity long-term view. And this graph looks a bit odd because of the very strange Legal & General result, which is going up, up and up. And that's not necessarily a function of having loads and loads of debt, but it's also a function of their equity values. All the other companies are below the 100% target. In fact, Direct Line is the best, just consistently flat, really low debt to equity. Prudential's been improving. Aviva is, yeah, that's pretty good as well. And Admiral, if we can find that, that's just edging up a little bit. So this is the one metric you'd have a concern on legal in general, but we will combine it with interest cover. And we also looked at that solvency ratio before, but we'll combine this with interest cover just to see how affordable the debt really is. And here is the interest cover. And what you can first of all see here is the ideal line is 20, the target line is 14. Now, Aviva has always been below. They've always had a lower interest cover. Direct line has always been very good, up from the last year. Prudential has been consistent. And see if we can bring up Admiral. They've had an amazing figure, although that's dropped quite a bit over time. And legal in general, that's been improving. So now we finish with the valuations, the price to book, which I think is a good way to measure valuation of insurance companies. And ideally, you want a price to book below 1. As low as 0.6, you can get massive capital returns probably. And 0.8, you've still got decent upside there. It's almost their net asset value compared to the market capitalization. Admiral is very expensive. Same with some of the other metrics, why they're expensive, because they have much higher interest cover, very high return on equities. Prudential is in that sort of 2 to 4 region consistently. Legal in general has been coming down just 1.1, so that's trading at around fair value. Aviva, that's dropped off a bit, they're a bit below book value. There might be an opportunity there. Direct line again has been between 1 and 2, but that's just gone below 1 now. And there we have it. So what you might say is, if you're looking at the valuation perspective to inform your buy decision, you probably discount Admiral and Prudential. All of the others there are kind of around about that fair value. Legal in general, Aviva and Direct Line. Which is your favourite out of those 3 companies? Right, ladies and gents, here is the dividend portion of my portfolio and all of the holdings and performance of those companies. See more on my monthly portfolio reviews. 3 of these companies are held in my dividend portfolio, so let's have a look at each of those holdings, find out the detail. I have a holding of around about £1,400 in Aviva. That makes it the largest of these companies that I hold. Overall return has been around about 18% a year. I would say the dividend of 19%, I would ignore that slightly because the return on capital, the way this share site software treats that, is part of the return. The overall return value is correct, but they just allocated a lot of that to the dividend. See here that I bought quite a lot in 2020, 3 years ago, about £2.47, and then some further additions to that position. And I've added a little bit more this year as well. And there have been some pretty nice dividends, including £61 received just a few days ago. My Direct Line position is less attractive. I've actually held Direct Line since 2015. I bought them at a much higher price than they are now, £3.40. The market price now is £1.65, so about half. But actually, my overall return is almost flat because the dividend has come in at almost 7% a year, and the amount that's come in has almost offset the loss in capital. So I've held this for all that time and made nothing. I haven't really lost money either. It's probably the worst of the 3 companies, but perhaps when they reinstate their dividend, there could be a spike in the market price. But I do need to have a think about this company. That's the holding. It's only worth now around about 0.5% of my portfolio. Last but not least, Legal in General has returned me 7% a year. Let's support them in May 2020, the first tranche. They're about 3% of my portfolio, and the return has really come from the dividend because actually there's a slightly negative capital return. Here is my activity, 2020 buys, and I've added a few more times as well. One of these companies, along with Aviva, my overall expectation is to get around about 8 to 10% a year from them over a long period of time. The combination of dividends, buying them at touch undervalued, and also with buybacks that they're doing as well. If you like Share Site, I will leave a link in the pinned comment below for you to get a discount. Really powerful way to look at returns over time because it gives you a per annum return across the different metrics and really allows you to assess how the companies are performing. So you saw that Aviva is my largest holding of the 3. None of this is financial investment advice to you, but if you are interested in Aviva, check out this message now, and thank you for watching. And to hear more about how Aviva To turbocharge your portfolio returns, click here. There you go.
Come on. Do it. Do it!